Hi everybody, welcome back. In the last video we looked at how a tax impacts, or how we analyze a tax using a supply and demand framework, and how we look at this from an economic standpoint. Now we're going to examine how taxes impact consumer and producer surplus and total surplus. So essentially, are people better off, are producers better off, and kind of where does it fit into the government? Okay, so one thing that we're going to have to deal with is what happens in our idea of total surplus with tax revenues. And ultimately, tax revenue is going to be put into total surplus because tax revenue can fund beneficial services. Tax revenue can fund beneficial services. So we include it in total surplus. In total surplus. Okay, and we can think about this as, roads, education, police. These are things that are providing welfare to the society. So we're going to include that in our welfare analysis. Okay, and so just a refresher, let's show what we have for consumer and producer total surplus when there's no tax. Remember, what we do is we take our equilibrium price and quantity. Anything above the price and below the demand curve is the consumer surplus. That's this triangle here. And anything below the price and above the supply curve from 0 to our equilibrium quantity is the producer surplus. And so the way that we calculate those, if you recall, is our base times height from our triangles. And so here we have both of these triangles are 30 by 15 triangles. So we have half of 30 by 15 for 225 consumer and producer surpluses, a total of 550. And in this case, there are no taxes, so there is no tax revenue. Okay, that's a simple one. That should be our refresher. But what happens if we put a tax into place? So now, and again, like we said, it doesn't really matter if it's buyers or sellers, but let's put a $20 tax. Remember, a tax can really just be thought of as a wedge between the buyers and sellers. And in this case, we've got a $20 tax. Trying to move that. There. A $20 tax is going to give us an equilibrium, or a new quantity of 10. And now buyers are going to pay $40. So what's above the price buyers pay and below their demand curve is the consumer surplus. Sellers are going to receive what's below what they receive. They receive $20, and above the supply curve. And then this $20 tax, all of that goes to the government. So $20 times as many items are sold, that middle area is the tax revenue. So our consumer surplus is a triangle, half the base times the height. The base is 10, the height is 20, for a total of 100. Same thing for producers, total of 100 in this triangle here. And then the tax revenue is the area of that rectangle, and that's a 10 by 20 rectangle. $20 by 10 is $200. Okay, and our total surplus, I'm just going to write that up here so it's altogether 100 plus 100 plus 200 is 400. Okay, and so there we have it, total surplus with a tax $400. Total surplus without a tax is 550 up here. So it's the same market, there's no difference. So what happens with all the rest of that surplus? 550 versus 400, we're missing something here. And that's going to be this area here. That's surplus that nobody is getting. And that's deadweight. That's what we call deadweight loss. So what about total surplus? That's up there. What about the rest? The rest of the 150, right? Because 400 plus 150 gives us our original 550. The original 550. So what happens to the rest? Where does that $150 go? That's what we call deadweight loss. Okay? And deadweight loss, which we abbreviate DWL, is the deadweight loss of a tax is the fall in total surplus that results from a market distortion. The fall in total surplus that results from a market distortion. Okay, this could happen from taxes, right? But we also end up seeing deadweight losses when we have monopolies and other market failures. And anytime there's some type of market distortion, the society is going to lose out. And so that's what's happening here. That's this triangle when we have our $20 tax in place. No producer is getting that, no consumer is getting that, and the government is not getting that. That is just surplus that society once had and now doesn't. Okay, and so what we have here, the reason that exists is because we used to have an equilibrium quantity of 15, and in that area there were sellers who were priced into the market. They were willing and able to sell. There were buyers here who were willing and able to buy. And now those sellers are out of the market. Those buyers are out of the market because of that tax. So if this is Q0 and Q1, we could also call that QE and QT for tax, E for equilibrium. Those units are not sold. And what that tax is doing is preventing some of those mutually beneficial trades. And so that's essentially the gist of what's happening there with taxation. Here we have, oops, just a moment. Okay, which goods? So when we're thinking about taxes and policies in place, a lot of times taxes are necessary, but when evaluating these, how should the government decide which ones to put in place and how to service their revenue needs? It needs to be the one with the lowest deadweight loss. Okay, and so you can analyze different tax policies to see which one is going to have lower or higher deadweight loss. One thing that we're not going to get into, but something that would make a difference, is the steepness of the demand curve or the supply curve, or what we call the elasticity. Actually, let me just kind of very quickly show you that here off to the side. If I draw the same supply curve in two markets, and I'm going to copy and paste that. Okay, and I want the equilibrium to be the same in both markets. Oh. Okay, but one market will have quite a elastic, what we call elastic demand curve, which will be relatively flat, and another market will have a relatively inelastic demand curve, relatively steep. So there's our equilibrium quantity and our equilibrium price in both cases. But now, let's say we want to put a tax into place that's going to be this big. Okay, and actually let's extend these, well, so as you can see here, in the more inelastic demand curve, consumer surplus is very high in the market B. In market A, consumer surplus is a lower. Producer surplus is the same in both cases. But now let's put this tax into place. I'm going to copy this. And so remember, the tax acts as a wedge, and we just put it between the supply and demand curve. Wherever that fits, that's going to be the new quantity. Okay? And so with that tax, here's our quantity with our tax, QT. And what happens to the consumer producer surplus? Well, producer surplus, okay, we're going to erase those. Producer surplus is again going to be this, actually it's not going to be the same in both markets, but producer surplus is here and here. Let's do the tax revenues in red. Okay, consumer surplus can be green. That's that little triangle there, but it's still a very large triangle here. And I'll just gray out the deadweight loss. So here, in the first market with an elastic, what we call elastic demand curve, and inelastic demand curve. In the second case, the deadweight loss is rather small, particularly relative to the first case. And so in markets that have extremely inelastic demand, like this one, meaning buyers are less price sensitive. So for example, anything that, as the price increases, like important medicine, for example. When the price goes up, people are still going to be willing to have very similar demand because they need it. So the demand, they're willing to pay extra high prices in order to still have it. When we have inelastic demand curves, a tax won't be as quite as distorting for the consumer surplus as it would be in an elastic demand curve situation. You could do the same thing where you mess around with the supply curve and making that more or less elastic or inelastic. But essentially, the shape of these curves matter a lot. And so in both cases, we had the same level of tax. In one case, the total surplus in society decreased by a lot less. So here's the total surplus, and here the total surplus increased by a little bit more as a percentage of what the total surplus was in the beginning. Okay, so that's just a little bit of an extra detail that gets into some other concepts of elasticity, which I have some other videos on in my channel, so you could go check those out as well. But otherwise, we can just summarize everything we've learned here. So again, it doesn't matter with the basic supply and demand analysis. It doesn't matter whether the tax is put on the buyers or the sellers. Ultimately, sellers pass on costs to buyers, and when taxes get put on buyers, their demand decreases such that they're not going to be willing to pay as much to sellers. So in the end, it doesn't matter between putting a tax on buyers or sellers. It makes it easier for analysis. There's going to be, when there's a tax put in place, a fall in total surplus. That goes to nobody at all. No buyers, no sellers, nobody. That's called deadweight loss. And ultimately, it kind of shrinks the welfare in the total market. So that gives a little bit of background into how we think about taxes. But what we're going to be looking at and thinking about in future videos is how we should deal with things that maybe ought to have a tax put on them, so that we don't end up kind of overusing or overutilizing different resources. So this is particularly relevant for environmental economics when we think about something like a carbon tax or other pollution taxes, and so on and so forth. So that's where we're going to be heading with the next videos in some more video series. This will give a foundation to help think about those things. But yeah, going to be coming out with those soon. So looking forward to seeing you there. Thanks.